Welcome to the D-Risk Weekly Global Markets Brief. It is Saturday, December 13th, 2025. Last week, we discussed the dollar capitulation and the market's aggressive bet on liquidity. This week, the narrative has shifted violently. We are no longer talking about liquidity. We are talking about growth. The theme of the week is the Recession Reality Check. On Wednesday, the Federal Reserve cut rates for the third time this year, lowering the benchmark to a range of 3.50% to 3.75%. In a normal bull market, equities would have celebrated. Instead, U.S. futures sold off and the Nasdaq slid nearly 2%. Why? Because the data accompanying the cut, specifically a spike in jobless claims to 236,000, shattered the soft landing illusion. The market has stopped treating bad news as a reason for stimulus and started treating it as, simply, bad news. We are witnessing a classic risk-off rotation. Capital is fleeing equities and oil and piling into gold and bonds. The correlation between bad economic data and rising stock prices has broken. Investors are now staring down the barrel of a potential policy error, fearing the Fed is cutting too late to save the labor market. Alex, let's see if this fear has permeated global markets yet. What is the signal from Asia and Europe?
Thanks, Sarah. Interestingly, international markets are lagging the U.S. sentiment shift. While the U.S. is pricing in a growth scare, Asia and Europe spent the week trading on local policy catalysts and stimulus hopes. Let's start in Japan. The Nikkei 225 rallied 0.68% this week, closing at 50,837. The driver here is the Bank of Japan's aggressive normalization path. Markets are bracing for a rate hike to 0.75% next week, the highest level since 1995. Despite the tightening financial conditions, the technical trend remains bullish. The Nikkei is holding a confirmed golden cross, with the 50-day moving average at 49,446 sitting comfortably above the 200-day at 41,703. Investors seem confident that the structural reforms and corporate governance shifts are durable enough to withstand higher rates. In China, the picture is more mixed. The Hang Seng Index drifted lower by 0.42%, closing at 25,977. The market is caught in a tug-of-war between Beijing's pledge for a necessary deficit to support growth in 2026 and the looming threat of trade friction. Technically, we still have a golden cross with the 50-day at 26,116 above the 200-day at 24,609. However, notice that the closing price of 25,977 has slipped below that 50-day line. This loss of short-term momentum suggests the stimulus euphoria is fading as investors demand concrete results. Moving to Europe, the divergence continues. Germany's DAX rallied 0.66% to close at 24,186. This is counterintuitive, given that German growth forecasts for 2025 were just downgraded to a meager 0.1%. Yet the technicals ignore the macro gloom. The DAX maintains a golden cross with the 50-day at 23,979, above the 200-day at 23,565. Traders are likely front-running expected ECB cuts. Finally, the UK's FTSE 100 slid 0.19% to close at 9,649. The UK economy unexpectedly contracted by 0.1% in the 3 months to October, making a Bank of England rate cut next week a near certainty. Despite the economic contraction, the long-term trend holds, with a golden cross where the 50-day at 9,625 remains above the 200-day at 9,038. Sarah, the international signal is one of denial. Markets are holding on to technical uptrends despite deteriorating fundamentals.
That denial is striking, Alex. Europe and Japan are holding technical support levels even as their economies contract or stagnate. It feels like they are waiting for a signal from the global mothership. However, the U.S. market is no longer waiting. It is reacting. The price action in the States this week suggests a decoupling from that international optimism. Is the U.S. leading the way down, and are we seeing confirmation across asset classes?
The U.S. is definitely leading the downside move, Sarah, and the cross-asset correlations are screaming caution. Starting with U.S. equities, the reaction to the Fed cut was undeniably bearish. Nasdaq 100 futures slid 1.94% to close at 25,213, while S&P 500 futures fell 1.11% to finish at 6,830. The tech-heavy Nasdaq led the decline, signaling that investors are liquidating the high beta growth trade. The bad news is good news regime is over. The market is now pricing in earnings compression. This fear is most visible in the commodities complex, specifically the divergence between oil and gold. Crude oil plunged 4.39% this week to close at $57. This is a massive signal of demand destruction. Technically, oil is in a confirmed death cross, with the 50-day moving average at 60.00 trading below the 200-day at 63.00. Price is being rejected at every rally attempt. The market is telling us that global industrial demand is vanishing. Conversely, gold rallied 2.07% to close at $4,300. As the data shows, gold is acting as the ultimate hedge against both recession and policy error. The technical picture is pristine. A golden cross with the 50-day at 4,102, well above the 200-day at 3,519. Capital is rotating directly out of industrial assets and into the safety of bullion. Now, let's look at the plumbing, rates, and the dollar. The U.S. dollar index DXY fell 0.60% to close at 98.00. We are witnessing a technical breakdown. The index has dropped below a convergence of the 50-day and 200-day moving averages, both of which are sitting at 99.00. This failure at key resistance confirms the bearish momentum we discussed last week. The market is betting the Fed will be forced to cut deeper and faster than they admitted on Wednesday. However, the bond market is behaving strangely. The 10-year Treasury yield actually rose, climbing 1.28% to 4.19%. Normally, yields fall during a growth scare. This rise amidst a Fed cut suggests the curve is steepening. Investors are demanding a premium for holding long-term U.S. debt, possibly due to inflation fears lingering at 1.9%, or concerns over the fiscal deficit. Finally, the VIX is waking up. It surged nearly 6% to 15.74. While not panic levels yet, the trend is upward. The complacency we saw in November is evaporating. Sarah, the dashboard is flashing red. Oil is crashing, gold is rallying, and equities are selling off. The recession reality check is here.
Thank you, Alex. That divergence between plunging oil and rising gold is the most critical signal on the board. It tells us the market is preparing for a slowdown, regardless of what the central banks say. Looking ahead to next week, get ready for a data avalanche. Due to the recent government shutdown, we have a backlog of critical reports releasing all at once. On Tuesday, December 16th, we get the delayed non-farm payrolls, retail sales, and CPI data. This cluster of data will confirm whether the spike in jobless claims was a blip or the start of a trend. Furthermore, the central bank action isn't over. On Thursday, December 18th, both the Bank of England and the Bank of Japan announced their rate decisions. With the BOE expected to cut and the BOJ expected to hike, we could see massive volatility in the currency markets, further pressuring the dollar index. This is not a week to be passive. The recession reality check theme will either be validated by the payrolls number or challenged by resilient retail sales. Watch the data, not the rhetoric. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.